FY25 is over and will be remembered as one of the most volatile years in recent memory, with a series of US-driven shocks from an assassination attempt to tariff hikes and rising geopolitical tensions, all threatening to oil markets. Ultimately, disciplined and patient investors have been rewarded with above average returns. Our balanced strategy, with around 60% risk exposure, returned over 10% for FY25. So what lies ahead for FY26? Our investment committee has been actively debating the outlook as part of our mid-year deep dive. The bulls argue global corporate earnings are expanding at an elevated pace. Central banks have shifted toward easy monetary policy, particularly here in Australia, and consumer spending remains surprisingly resilient. On the other hand, bears point to equity markets that are back at record highs, yet the foundations of globalisation and free trade are under more pressure than ever. Savings rates are rising, a sign that households may be bracing for tougher times ahead. And after decades of relative peace, major economies are ramping up defence spending, potentially at the cost of higher taxes and reduced social support. Escalating tensions in the Middle East, particularly involving Iran, raise the risk of policy missteps that could ripple through global markets, causing a spike in commodity prices and a jump in inflation. That would complicate the outlook for interest rates and asset valuations, especially with growth already softening, a situation that we saw in 2022. So how are we positioned? Well, firstly, we are underweight domestic and UK equities, where growth and productivity remain weak. Secondly, we're neutral on the US equities, recognising strong earnings but staying alert to rising valuation risks. We're overweight commercial listed property here in Australia, where government spending, lower interest rates and low growth backdrop are supportive of real assets. And finally, we remain overweight in our core interest income strategy, taking advantage of historically high yields while adding resilience to portfolios. As asset allocators, we seek to manage risk on the downside while staying positioned to capture upside when it emerges. This balanced approach has delivered stable, long-term returns for our investors and continues to guide our investment positioning. Thank you for tuning in, and as always, if you'd like to discuss our views or your portfolio, please reach out to your client service team.